daily programming do not necessarily reflect the views of the management or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, so how much risk should you take with your mortgage? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, please go to the website at www.prudentmoney.com. Send it in to the Ask Bob section and I will get it taken care of. It's a great way to get information all at the website, www.prudentmoney.com. Also, make sure that you do know that we have an active podcast that we download off the program every day, Monday through Friday, and it's there for you to listen to at your leisure. We are publishing on any, pretty much all the podcast platforms, so make sure you go check that out at prudentmoney.com. Well, you've heard of companies, maybe financial advisors, for charging too much in fees and for retirement plans and getting in trouble for it. In fact, there's been lawsuit after lawsuit that would state against company 401k plans that their fees are just too high, and their funds that they're charging these higher fees on are underperforming the market. And I've always said to kind of take a couple steps back from this argument, because people are pretty will debate this. In fact, I've had people, listeners, send me a 10-paragraph email telling me why I'm wrong and they're right about low-fee mutual funds. When in reality, just to cut to the chase, there's a time for low-fee mutual funds and there's a time to pay higher fees. And that time to pay higher fees, it only makes sense to do so if you get something for it. Pretty simple, right? For those who are paying higher fees to chase the market and try to get market-like returns, well, you're probably overpaying for fees because a simple low-cost index fund will do the job. So I could do that, and I could rebut those emails with a paragraph. It's just really not that difficult from an understanding standpoint. But I saw an article that actually made me take a step back and say, well, maybe here is some progress to balance things out. And I think that to the bigger picture, one of the things that we're seeing are trends, and we're going to talk about this in the webinar Wednesday and Friday of this week, is that we are in a time period where everything seems to be going haywire, where everything seems to be going to the extreme. And one of the things about going through this period of time, and this cycle of time is something that countries have been going through, civilizations have been going through for thousands of years. And we are in that particular spot in the cycle, and like I said, we'll be talking about this, where we start to see things go to the extreme. And one of those this to me is a small example of it. The extreme is that companies are told with their 401k plans that they choose and they put together and they approve of for their employees to have to really look at it on the merits of fees more than anything else. That the fees are low. If the fees are low, that keeps them out of trouble. If the fees are low and the fund, of course, doesn't take too much risk and blow up or something like that. Well, now, this article, I'm just going to read the first paragraph to you. It says, retirement advisors have long known that they can be damned to litigation misery if they steer investors into higher fee managed funds, even if they do so while adhering to their fiduciary duties, which is just always blown my mind. Now they're learning they can be damned if they don't. That is, if they don't recommend high fee funds and instead go for low fee alternatives that promise less risk but perhaps smaller returns over time. Plaintiffs' lawyers have begun promoting the novel idea that retirement fiduciaries should be legally liable when those low fee funds turn out not to perform as well as other investments that were on offer. And this is, it's either too high or it's too low, and now they're bringing in performance into the scenario. It's really pretty simple the way categories of fees work. First of all, you have the very, very low fees that are charged, and it comes down to you get what you pay for in almost every circumstance. The low fee-based exchange-traded funds or mutual funds are designed to passively move with a market, like you say the S&P 500, for instance. So there's no management involved. There's really nothing there that requires the mutual fund company to charge very high fees or anything like that. I mean, it's kind of on autopilot. So they just charge these very, very minimal fees. Then number two, you have your higher fees on some of your mutual funds that have a management aspect to it. See, most mutual funds, this is something that's important to understand, most mutual funds don't have a strategy involved with their overall fund. They pick stocks, so they have a stock picking strategy, and then they hold on to those stocks no matter what happens. And of course, like today, they're paying for it in more ways than one because the market's down, and of course performance is down because it goes up and down with the ebbs and flows of the market. But if you look at these funds that have an active management strategy attached to them, maybe the market's down 25, maybe, and in fact I know a lot of these funds are maybe down 8% or 5%, but they're not down 20 or 25%. And then they recover just like the other funds recover. And I've done tons and tons of research and studies on this throughout the years. And there is a definite place for these higher expense charged mutual funds that provide a service and a value for the higher fees that you pay. Now, let me give you an example. Let's say that you are investing into a S&P 500 index fund, and that mutual fund goes up and down with the market. It takes the exact same path as the market minus a little bit of this paid for fees. And let's say that there is 0.05 or 5 basis points of fees. 1%, a 1% fee would be 100 basis points, so we're talking 5 basis points, which is nothing, absolutely hardly anything. So that fund goes down, let's say with the market, so let's say that the market goes through a bad bear market, and that fund goes down 50%, versus a fund that you're paying 1.25% fees, way more fees in the lower fee fund, and it only went down 6%. Are you going to be at being down 50% versus 6%? Are you going to argue over 1.25% difference between the funds? No, you're not going to argue about it. You're going to be happy that you're only down 5%, 5 or 6%. You're not going to say, "Wow, I'm certainly glad I paid lower fees and I'm down 50%." And the other thing that you have to know is there are funds that, through their stock picking, try and emulate the S&P 500 by actively managing their stocks. So they're trying to take stock market risk and they're trying to beat the market. So many active fund managers, I mean, it's just a shot in the dark, are to where that they are actually successful at doing that. So my argument's always been that's where the index funds, that's where the lower fee index funds come into play and make it for a good investment if you're trying to get market-like returns, but you don't you want to pay as low as fees possible. Well, that totally makes sense. So there's a room for every kind. And what I've seen, I've watched as 401k plans have shifted over to everything's low cost, so they can check that box. But literally, when it comes down to, and I'm looking at lots of 401k plans, people send them to me today, and they're saying, what should I be doing differently? I'm losing a lot of money, but there really is not anything low risk in there that's a fund that's managed with managing for risk in mind. Thus, the higher fee, because mutual fund sponsors, corporate retirement plans, are shying away from that because of the potential liability. So this really throws a wrench into it, and I love the fact that I've come across this article, because it shows that, hey, there is another side of the story. And you have to understand a little bit more fees instead of just coming to the conclusion, well, high fees are bad. Well, that's not so much true all the time. High fees can be bad. They can also serve a purpose, which I think they're starting to figure that out. Hey, this is Bob Brooks. If you got a question for me, please go to the website, because we are up against a break. Stick around, and I'll be right back. Hi, this is Bob Brooks, host of the Prudent Money Radio Show. Well, 2022 has been a miserable year for investing. Will 2023 bring the same? You know, times like this have a way of making us feel stuck, not knowing what to do. Well, there are two keys to success in any kind of market. First, you have to be informed, but second, you have to receive that information in a way that anyone can understand it. This is my objective with the next Prudent Money webinar. There are 5 main questions that you should be asking right now. Number 1, what is a bear market, and what does a bear market really look like? This could tell us a whole lot about 2023. Number 2, why is it important to understand cycles when it comes to growing my retirement? Number 3, what do I need to know about inflation? You know, how high will these prices go? How do I protect myself from inflation? Number 4, why should I be careful with bonds? Number 5, what steps do I take now? You know, what are my options? Well, if you're unsure about the future, then this webinar is for you. Sign up now for the 5 questions that could save your retirement. There's 2 times we're going to present this webinar. The first one is on Wednesday, October 26th at noon, and the second one is Friday, October the 28th at noon as well. Today, sign up at prudentmoney.com.
I'm John Eder of Live the Word. I want to invite you to join me at 4:45 weekdays right here on KDKR 91.3 FM. We look at our world in light of what the Bible says the world's going to look like before Jesus Christ returns. And we answer some important questions, very practical questions about how do we live in a day like this. So join us again, 4:45 p.m. right here, 91.3 FM, Bible School Radio.
Let's not only buy the truth, let's be the truth. Let's tell the truth, the whole truth, nothing but the truth. Let's stand against the things that are false by standing up for the things that are true. Let's stop posturing and actually be the people we want people to think we are.
Join Dr. David Jeremiah for his series, The World of the End, next time on Turning Point. Weekdays, 9 a.m. on Bible School Radio 91.3.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Listen, if you got a question for me, please go to the website at www.prudentmoney.com. Send a question into the Ask Bob section, and I will get that taken care of for you. That's all at the website, prudentmoney.com. Well, Wednesday and Friday, 2 opportunities. I'm going to be hosting the 5 questions that could save your retirement webinar. And they probably just heard the promotional for it during the break. But I think this is an extremely important webinar for you to attend, because these are literally 5 questions that I think everybody should be asking right now. I always get that question: what questions should I be asking? What should I know? This is information that is important for you to consider, and I'm going to be going through it in about a 40 to 45 minute max retirement webinar presentation. That's going to be Wednesday at 12 noon, and it's going to be Friday at 12 noon. There will be time for questions, and I will do a better job of making sure that that's facilitated a little bit easier. It's always in live seminars we get tons and tons of questions, and that ends up actually lasting for a long time. It's a little bit more difficult to do it in webinar form. But anyway, we're going to be doing that. We're going to be looking at bear markets, what you need to know about bear markets, and we're going to be talking about one aspect of investing that you will never, hardly ever read about in mainstream media, but I think it's extremely important. I'm going to talk about the one chart that completely changed my way of looking at investing that was back in 2002. And most importantly, we're going to talk about what steps do you take right now. Should you go towards bonds? What should you be careful about with bonds? And then we're going to talk about inflation and what you need to understand, how this inflation issue can get better or can get worse, what to look for, how to protect yourself from inflation. So we're going to be talking about all of that information and your options. And all you have to do is go sign up at prudentmoney.com. And once you go to the website, you'll see directions to go do that. So that's off the website, www.prudentmoney.com. If you got a question for me, also go to that website and send it in. I love to get those questions, and I will answer that. One of the things I've started to do is talk about just observations of conversations that I have, people that I talk to. I talk to a lot of people during the week, and the blessings of interesting conversations. And wanted to just take a second and comment on adjustable rate mortgages. If you took interest rates, and I think they're, roughly, last time I talked to Mark Pfeiffer, which was last week, he said they're roughly at 7%. I would think that they would still be there today. Excuse me. So 7%, and as they've climbed it to 7% from about half of that to 3 to 3.5%, you can see the activity in real estate start to go down further, because a person could afford a home with the premium attached, where you go, there's a list price, and then there's what people are willing to pay for, which is way over list price. They can sort of navigate that with lower interest rates. But when you start to get higher interest rates, therein lies the problem, is that they can't really afford the payment as it is. So one of the things that you'll see to help facilitate the flow of interest rate transactions, to see people getting to a point to where the activity is staying somewhat relatively stable, banks will roll out these plans to make buying a house a little bit more affordable. So the kind of the thought is let's help out a little bit. We're already helping out a little bit on the price wise, because we're starting to see prices settle to come back down a little bit. But let's also help on the mortgage, from the mortgage standpoint, and settle those prices down as well. So, and they come out with things like the adjustable rate mortgage. And the adjustable rate mortgage is a lower interest rate, but I got to tell you, it's not tremendously lower, but it's lower. And it stays that way for 5 years, to say if you got a 5-year adjustable rate mortgage. And then after that, it starts floating on an annual basis with interest rates. and your payment could get significantly out of hand. And one of the things that I wanted to make sure that you consider today, if you were looking at something like that, and nobody knows, I mean, you could make an argument for, well, interest rates will be way down by then, by 5 years from now, and you can refinance. Well, that's the idea, and that's the plan. But what if they're not? I've looked at, we're going to look at this at the webinar, is the history of inflation. And how long does it really last? Well, it could last. It could still be around for another 5 years, keeping interest rates high. So you just don't know. It's really a tough call as to where interest rates will be. I could make a definite case for them being lower, way lower, because I believe that we are in what's called not an inflationary, but a deflationary environment as well that would push interest rates down. But in the event that they don't, your interest rate starts floating after 5 years and could get really high. This is one of the things that led to, not specifically, but one of the small components of why the real estate markets just kind of blew up in 2008. It's because all these adjustable rate mortgages were coming due, and people were going into foreclosure because they couldn't handle the payment. Now, once again, not to say that 08 was exactly like this time, because it was a totally different situation. But my point that I'm slowly getting to is when we think about prudent decision making when it comes to money, and we're contemplating making unarguably probably the biggest purchase of your life, it is so very important to make sure that you're doing it and you feel comfortable that you're doing it and you're at peace that you're doing it in God's timing. And when we're actively praying about a situation, and I thought about something today after my prayer time that I thought, I'm not actively praying about this particular situation. I need to be actively praying about this. And when I say actively, it's not just kind of here or there. It's intentional prayer time, day after day after day after day after day. It keeps that always, and you know this, keeps your level of peace up about whatever you're praying about. And it keeps your peace to the point where you say, it's okay if God has not opened that door yet. But the other side of that coin is that we want that house, we want that car, we want whatever it is that we want, and we force the doors to come open. In a prayer for a situation that is rooted in prayer, that you're doing all the homework, you're doing all the math, you're not allowing emotion to get into or you're controlling as best as possible, let's be realistic, into making the purchase. If you're doing that, I totally believe that even though it still may be scary, God starts opening doors. And you can see those doors open, and you get that sense of peace. And even God may open some doors and you're still not getting that sense of peace. I mean, that could still be the situation as well. But it's important that the objective being that you're at that peace, as opposed to pushing the doors open. Now, let's bring the ARM into the adjustable rate mortgage into this conversation, back into this conversation. Let's say that you are already with a higher mortgage rate, you're pushing the envelope, and you're in a situation where it's going to rob some of your freedom in regards to your monthly cash flow if you go through with this. Well, what if I do an ARM? And that's, it's a situation where where you can get a lower interest rate, you can get a lower payment, but you're still kind of pushing the envelope on the cost of the mortgage payment. And you've also now introduced an uncertainty, what happens in 5 years. Hopefully the best case scenario will happen, but you just never know. So is it a good idea to go ahead and push forward if you've got a tremendous amount of peace about it, that you're not trying to kid yourself, absolutely push forward. But if you still have that feeling that, I'm really trying to force this to happen, that has, in my experience, has never been a good decision. Anytime I have to force something to happen. The whole point is to be in God's peace and surrender to that peace, and then look for the peace to go forward or the peace to just shut it down. And then even though you might be disappointed, maybe a little bit frustrated, you soon come back to, hey, the whole point was to be at God's peace. And that's where it is. It's not to do this. And because the thing about the real estate markets, to keep prices, to keep transactions going, you're going to see a lot of financing deals that may bring that payment down for a bit, that could cause bigger problems down the road. So we don't know. Who knows? It's always a tough one. But I just wanted to throw out that observation. Hey, don't forget to go sign up for the webinar that's going to be this Wednesday and this Friday. And make sure you do that and get that taken care of. If you got a question for me, please go to the website at prudentmoney.com, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.